Hello everyone, this is Matt Curfman here with Richmond Brothers for a May 2018 edition of Matt's Minutes. We have wound down the month of May and we have just started off June. And first and foremost, I wanted to thank all of our clients and all of our friends who came out to the Ella Sharp Art, Beer, and Wine Festival this past weekend. It's one of Jackson's biggest events. And we just heard that they had an estimated 5,800 attendees, which dwarfed last year's numbers, and it keeps growing. They had a lot more artists and vendors, both in food, local breweries and wineries from around Michigan, and just a really great weather day for all of Jackson, so that probably helped. So thanks for coming out. Richmond Brothers was one of the sponsors of that event, and so we're happy to be part of that and proud to be out supporting our community. On to financial data. We've now gotten past where almost all of the earnings are out for the first quarter of the year, and when you compare year over year, earnings were up about 24% or 24.5% from this time last year, and that is one of the most significant margins in many years. And again, this is earnings, not the stock market, but earnings of corporations. And why that's important is that's a key economic indicator that we watch to help us make determination, as we move into the future, when do we reduce your equity exposure if we think that recession is coming potentially towards late 2019 or maybe into 2020. So given the continued growth in earnings, we also have a period now where corporations especially are feeling the benefits of tax relief. There's been some relaxed regulation on industries that I guess you could describe they were previously straining to cut through the red tape, just to keep complying and keep up to speed. And so in addition to that, as companies release their earnings, they did continue to offer increased guidance for the coming quarter and for the coming year, so through 2018. So again, financially, that gives us a good indication that we do want to generally hold on to stocks. We're not looking to skim your stock exposure. And the reason we'd want to skim any of your individual stock or equity exposure is if you just felt uncomfortable or felt like your risk was too high. Outside of that, if we get to the period this year where we skim any gains that happen in the remainder of the year from a stock, we'll probably keep buying more stocks. Going into 2019, you might see that trend shift where we start to get a little more conservative, a little more balanced. So far, GDP, gross domestic product, is coming in at 2.2%. That's probably a little lower than economists would like to see it, but it's higher than it's been in quite some time. That's a good sign. Unemployment has come in at its lowest level in a half century. And we do have the Fed raising rates, and we have the 10-year Treasury getting up to around 3% a couple different times. And that's a psychological barrier, but us getting up to 3% hasn't collapsed the market. Lastly, May is a psychological month in the markets. There's an old adage out there that says sell in May and go away, come back in Labor Day as far as the stock market. But we're actually thinking that despite continued volatility, we've had a couple of 10% corrections this year. Given all of the economic signs, we still believe that 2018 will turn out to be a positive year for the market broadly and for our clients. We haven't seen significant gains across equity holdings year to date. We have one or two holdings that are kind of keeping us in check at the moment. However, when you look at the S&P 500, the S&P 500 is up about 2.5%. But if you back out one or two really big stocks like Apple and Microsoft, the S&P 500 is actually down 2% year to date. So again, there's a few key holdings that are really driving the market forward, and just being aware of that. The Dow Jones is relatively flat year to date, and so we're not looking for great expectations and great returns in the moment, but we think we do own really good companies with a lot of fundamental focus and shifting forward to higher revenue growth, higher earnings. Telling you all this because this is indicative of why we're still holding stocks in your portfolio. Our crystal ball still tells us late 2019, early 2020 for next recession. And so as we head into the summer, our message would be basically to stay the course. We'll continue updating you on individual basis through your calls, phone calls, or emails on your individual portfolios. We are super grateful to have the opportunity to work for you. And as always, if you have any questions, comments, concerns, please make sure and contact us. questions@richmondbrothers.com. Thanks so much for tuning in for May, and enjoy the great start to summer that we're already seeing.